Welcome back to the Educated Home Buyer, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. So back with me this week, we have Mr. Josh Lewis, resident mortgage professional. And today we got some news. The Fed has decided once again to hike the Fed funds rate 3/4 of a point. At the same time, we've got pending home sales numbers down 8.6%. We got mortgage applications down. The world is falling apart. Josh, what are we going to do?
You and I need to go like figuring out how to sell used cars or something, because there's not going to, apparently the world is coming to an end. Home prices are going to crater, and we're all going to be out of work because no one wants mortgages or homes.
No, being facetious, of course. So we're seeing inventory levels rise to some extent in many markets out there. Locally here, property Orange County sits at 4,040, a little bit less than last week, or pretty much right in line with last week. Huntington Beach at 245. That is actually less than last week. Homes are still selling. People, believe it or not, there are actually people that still need a place to live and they want to own a home. And so that is why we are here, is to guide you through that process, answer your mortgage and real estate questions. But Josh, let's talk a little bit about the Fed, right? So the Fed, this whole week, the market has been pretty calm leading up to the Fed meeting, right? We saw the 10-year pull back nicely. In fact, I don't know if that started on Friday or if it started this week, but nevertheless, it did pull back. So, and the Fed delivered, which we expected them to do. At the same time, they came out and essentially gave the market what they wanted to hear, which was that they're monitoring the market and will, basically continue to do what is necessary. But they didn't really give any indication as to big hikes in the future. And the market, I think, agreed with that. What are your thoughts on that, Josh? How did it impact interest rates? What are you seeing? All that good stuff.
So we have two equal and opposite forces that are kind of keeping us range bound. If you look, rates go up, rates come down, but they're not really moving anywhere.
The good and the evil.
Yeah, so we're just stuck there in the middle. And what we have on the force that would keep pushing rates higher is inflation. We have negative real interest rates. The 10-year ended at 2.76 today, Jeb, and we've got our last inflation read was 9.2%. So if you invest in treasuries, a 10-year treasury, and you expect to hold it for 10 years, and you expect inflation to stay at 9%, you're actually losing 6.5-7% on your investment. So obviously the market's telling telling us they do expect it to normalize, but it hasn't yet. We keep going on the three last monthly CPI announcements. The markets are telling us we're going to see inflation moderate. We've seen peak inflation. It's behind us. It hasn't been, and it's not. We're going to see another hot number coming up here in August for the July numbers. So on the other side, we see slowing growth. We've shown you guys the GDP Now index at the Atlanta Fed is showing very slow to negative growth, going on 2 consecutive quarters. We saw some really negative numbers coming out early this week. So long way of saying those forces are probably going to keep us in equilibrium here with rates about where they are until one of them gives way. If we got really hot economic news that said the economy was on a tear, rates would shoot higher. More likely what we're going to see is the impact of the Fed hikes continue to slow the economy, which part of their announcement today was saying, we're okay with that. You can't have both. We can't bring inflation down and keep the economy humming along, and we are okay sacrificing the economy to get inflation under control. And it's probably the right decision. Of the two, the ultra high inflation of the last 3, 4, 5, 6 months has been the bigger issue. The problem is the tools they have at their disposal don't completely address all the causes of inflation. So they're absolutely going to bring it down. I don't think we're going to see it back to their preferred measure of 2% for a while. But in the interim, rates, as you've pointed out multiple times, Jeb, for the best qualified buyers, had got up into the low 6s. Now we're in the mid to low 5s. And, long term meaning 12 to 24 months, probably somewhere in the low 4s is the appropriate number for the best qualified borrowers. But for the foreseeable future, we're going to be in this range until something gives way, either more economic weakness and inflation coming down, or inflation staying high and the economy heating up.
No, I mean, that's good stuff. For those out there listening, what I've seen here personally in the market, and I told Josh this earlier, is that rates have kind of, like he mentioned a moment ago, stabilized a little bit, right? So they've been trading in this little range, maybe an eighth here or there, up or down, or what have you. And the Fed coming out and raising the Fed funds rate didn't upset the market. In fact, the last CPI reading from a week ago, 2 weeks ago, didn't upset the market. Market kind of took it in stride and moving along. Those are good things because that, provides some stability, less volatility in the market, all of that stuff. But with that, I've actually, the last 2 weeks, week and a half or so, give it 2 weeks, I've seen activity in the market pick up with regards to showings, with regards to the number of people interested in property. I've had a property on the market for a little bit here, 2 offers all of a sudden. Now, we have done a price reduction, but it's been sitting on the market at the current price for, a little bit over a week, 10 days prior to us getting the offer. So all of a sudden, there's this idea that, maybe the market has settled a little bit and people are getting back in. I don't know. But what I can tell you is that I'm seeing less inventory come to the market on a daily basis. Now, I don't know if that is short term or if that's something that's going to continue. There's a lot of people in my market that believe that, normally we would have already seen the peak in inventory for the year, right? In a normal market. This year we're still not back to normal, although some things are normalizing. But even with that, that peak that would have happened earlier in the year, we're seeing, we saw it, continue past what it normally would. But over the last couple of days, I've seen less and less inventory coming to the market. Now, again, I don't know if that's a trend or if it's something that is going to change and all of a sudden we're going to see a spike again. We'll keep you updated, keep you in the loop as to what goes on. But imagine, these properties coming to the market, and then all of a sudden, we talked a little bit about it today in a meeting that I had, and it was, how many of those sellers out there, we've seen inventory rising. How many of those sellers are really real sellers? Or are they sellers that potentially missed the peak in prices and just want to see if they can still get it on their house? If they can, maybe they sell. If they can't, maybe they stay put. And so I think there's some of that. It's really difficult to tell at the moment. But what I think will happen as we move into the latter part of the year, when the market typically slows down, that holiday season, you could see a lot of this inventory drop off in addition to what would normally drop off seasonally, just because these people aren't serious sellers if they don't get their price. So it's interesting, a lot of changes going on. But Josh, what do you, I read an application or I read an article that mortgage applications are down to what, a 2-decade low. So less people looking for applying for a mortgage. Now, I know a large percentage of that is refinance business and what have you. What do you chalk that up to?
I don't know, because I was kind of shocked by the number, and then I sat back and thought about it. And I told you, you had asked, a couple of weeks ago, hey, how much refinance business are you doing, or how many refi applications coming in? I said, what refis? Like literally, like it surprises me. I think the number today said 31% of the market is refinances, and that just seems high. Like anything over 20%, and that's way beyond what our expectation was. In the fall. Thinking that rates would go higher this year. I looked back for California all the way back to like 1990, what the lowest share of refinances was. And there was a period in the early 90s where we had one year where it was like refis were 18% of the market. And California is interesting because people have a lot of equity. They're market savvy, so they're in and out of the market. They refinance more often for lower rates to take cash out. So I thought really like 35-40% was our downside. And for us, if I went back and looked the last 90 days, because it skewed higher the first quarter, we still had a good chunk of refis in that first quarter. I would say we're probably at like 20%. So it was kind of surprising that that number was as high as it is. But the bigger question you had is, what do you attribute this lack of activity? And I look at it, and for me, relative to say 2008 when everything turned, that just seemed sort of like the market was just done. Like values were dropping rapidly, and people were getting into distress. So at that time, it seemed much worse to me. And what, that was 15 years ago. So if we're saying going back to early 2000s or the least activity, even look at that in 22 years. If we say 2000, you had some issues with the tech wreck in the economy, but 2000 was still a pretty good year. Rates were low, so surprised me that was the negative comparison 22 years ago. But what I will say, and you're saying activity picking up, I said activity picking up, more calls, more people interested. The biggest difference between now and last year for us on the mortgage side is I'm still having a ton of conversations. So there's lots of willing demand, people wanting to buy, far less able demand, meaning people that actually qualify. And I don't mean, hey, you don't qualify for a mortgage, but you qualify for 625 and homes in your area are 875 now. So it's sort of expected, but sort of surprising the scope of the numbers.
No, I think you nailed it. Like, I throw this referral link up on the screen often for people looking for a mortgage professional, people looking for a real estate agent, which I'll throw up here on the screen in just a moment. But these are people looking to buy homes in different areas of the country. Now, many of them might not know what that process entails. They're new, they're first-time home buyers. Many are seasoned buyers or seasoned with the process, if you will. And every day, this is in different markets, but every single day there's a handful of people, right? And that's just coming to me. So there are still willing buyers. It's the able part that is the dilemma. In the pending home sales numbers that came out today, Lawrence Yun, chief economist for National Association of Realtors, came out and said the cost to purchase a home went up 80% in 3 years. That number is staggering. From June of 2019 to June of 2022, 80% increase in cost between home prices going up and interest rates again changing. Numbers nuts. So just that's why you're seeing more normalization than what would normally happen during this time of year, is because of that affordability play.
Jeb,
so Josh,
I know you have a direction that you wanted to go, but let's go back to a conversation that you and I had just a couple days ago along the same lines. People who are sitting here, it's funny. This is the first time we've had a downturn in the housing market when social media was a huge thing. So social media doesn't work off of subtlety or nuance. It's, I'm going to club you over the head with the biggest, meanest, nastiest word I can come up with. So whether it's bubble, whether it's crash, that's the only thing that we talk about. Hubris, all of those. So what we were talking about, Jeb, is that there is a difference between other assets, crypto, stocks, Those things have little to no utility to you to own. Your house puts a roof over your head. Unless you're going to move back in with your parents, if you sell your house to avoid what you think is a coming crash, you still have housing costs. So rents, as we've all noticed, are really expensive also. So you're not avoiding a high monthly cost. So you're also going to have transaction costs on the way out. 5 to 8%. Is that a reasonable number, depending on who you quote and where you are in the country and how much your realtor wants to work with you? So you're going to take a 5 to 8% haircut. And at some point when you buy back in, you're going to have 2 to 3% costs again. And there's a likelihood that you're going to buy back in at a higher interest rate than your current interest rate. So owners, we've talked about current homeowners have huge equity positions, so a big cushion to absorb a small downturn in prices, very low interest rates, excellent credit, and these people are unlikely in mass to want to become renters or move in. I mean, we've seen historically plus or minus 65% of American households choose to own. That number bottomed, I believe, in the low 60s. It might have gone into the high 50s after the last downturn with a wave of forced sales. So a long way of saying, if you thought the market was going to drop 20%, by you selling today, which you imagine is the peak, you're locking in somewhere between 5 to 10% of costs in selling costs and buying costs back in, and buying at a higher interest rate as well. So there are strong reasons why home prices are sticky to the upside. You have to have a strong desire and need to give up what you have, or a very strong belief that you are the world's greatest market timer and are going to pick the peak to sell your house, and then also be able to identify and get back in at whatever the bottom may be. So big picture, home prices are sticky to the upside. That doesn't mean they never deviate, that they never have a downturn. Bubble, crash, it gets clicks, but it's not the reality of what we're looking at based off of those facts.
No, and we talked about this, and actually after that conversation you and I had, Josh, about this, I actually shot a video. I don't know when I'm going to post it, but I mean, we've talked about it before. The idea of, the stock market going down, your stock goes down, you can sell it. It costs you nothing, basically, with all of the platforms out there now. Zero, pretty much, maybe $7, $8 to sell a stock. To sell your house, the cost is high, right? I mean, you don't have to own a stock. You have to own shelter somewhere, and you don't have to own. You can go rent, but I think we all know with regards to what's happening with rents. I mean, in fact, I have a client here locally that bought a property, and when we bought the property, we said probably $4,200 or so in rent for the property. And looking at the market today and looking what's out there for available rent, we're probably going to push it to $5,000, and we'll probably get multiple applications. So $800 increase in, I don't know, 6 months, because of the lack of available options out there. So you don't have to own, but you got to live somewhere. So you guys that, need to decide if it's the right time in your life to be a buyer. And if it's not, then you sit and wait until it is. And maybe it never is. I don't know the answer to that, right? We're not here to get you to pull the trigger. It's really to provide the education and answer the questions so that you guys can make informed decisions. So Josh, someone in the chat, when I say someone, I did mark it, but I wanted to put this up there just so we can look at it. And then I'm going to find that chart from yesterday too. Somebody said something. I have no idea where it is, but anyhow, I'm going to post this because somebody in the chat mentioned that it was, let's see, we're already in a recession based on 2 quarters of negative growth. So at the moment, the Atlanta Fed GDP now shows that we're just under 1%, 1.1, 1.2% or something negative, right? So they update this, I think, every Thursday. It won't be finalized until the end of September, I believe, the end of the quarter, if you will, at which point they'll determine if we're in a recession. So by book of a recession, we're not in one yet. Now, many people out there will argue and say that they're feeling the effects of recession because of the inflation, because of whatever. Job growth is still very, very strong, and probably the primary reason that we aren't in a full-blown recession at the moment. But Josh, anything you want to add to this chart here? I'm going to add one more here in just a minute once I find it.
More fun things to remember. So recessions are always called looking back. So what is it? The NBER, the National Bureau of Economic Reports, they will call the recession well after the recession. So it's not uncommon that no one has said, hey, we are in a recession. But remember, we're looking at this chart here that's 2022 Q2. So Q2 is over. We got the initial read. There's going to be one more read and then the final read. So it's probably 6 or 8 weeks before we would actually know that we had 2 consecutive quarters. And it's important to note that the 2 consecutive quarters of negative growth is a rule of thumb. We've never had 2 consecutive quarters of negative growth without the NBER calling a recession in retrospect. But they look at 3 things. It's depth of the loss, duration, how long it lasts, and dispersion, how far it spreads throughout the economy. So there is more to it, and they probably have an actual formula that they're looking at. But normally I'm very distrustful of all types of government, but this isn't some type of government conspiracy to not call this a recession.
Got it. Good stuff. And then I'm going to add one more here, Josh, that you and I talked about yesterday. But there is someone in the chat talking about it, so I thought it'd be worth bringing it up just so we can chat about it here. So this one, new home inventory. So this has to do with new construction. So this goes down to Rodrigo's comment of 9 months supply of new construction homes. So when you hear that, sounds shocking. Sounds a bit scary, in fact, when you hear how many homes are being built. And then you go and look at the numbers and see the red there is actually how many homes have been completed with regards to new construction. It's under 1 month supply of homes. Now look at the blue. The blue are homes that are under construction. These are homes that are being built, likely have buyers in some cases already in escrow on them. So these aren't all just available properties with no buyers in contract, right? These are properties that some of them could be, new builds without anyone buying them. Others are already under contract. But there you've got what? How many months is that? 4 or 5? I don't know how many months it is right off the top of my head, but it's a decent amount, 5-6 months of supply there. Why? Supply chain bottlenecks, all of these things put a hiccup in these properties being built, and therefore they're still under construction. Now, the green at the top are properties where permits have been pulled, but they haven't been started yet. So these are properties that are probably going to be on hold for many builders out there until they figure out what's actually going on with the market. Now, some small markets like the community that I'm in, Huntington Beach, 200,000 people, there's a couple of new construction projects where they've pulled permits. I'm aware of them. They're likely going to continue with those properties. Why? Because there's very little inventory in my market. Now, if you're in a market, say a Houston or one of these markets where there's a lot of construction being built, a little bit more of a concern if somebody starts a new project. Therefore, it's probably going to be put on hold. But just make sure when you're reading the headlines and you see 10 months of supply, 9 months of supply, you actually know where that supply stands. All of this isn't going to hit the market at one time. It's going to be spread out. Will some markets have a bigger impact because of the inventory? Absolutely. Will some markets not feel it at all? Absolutely. Right? So real estate's local. Pay attention to where you are. Josh, anything you want to add on that one?
I just had a question. Do you know,
Yeah.
Is that just single families or does that include multifamily in this chart?
This is just single family. Yeah. So,
Okay.
so multifamily, there's another chart. Did I pull that one up? I don't know if I did the multifamily one or not.
The multifamily is more problematic for builders from my take on it, just because the economics are so much better for builders in terms of building multifamily that's been where they've gone. And part of if you're in a different part of the country, it may be different. But for us here in Southern California, if you get any parcel of land, you put the densest apartments you can find on it, and over the long haul, you're going to make a lot more money than even putting condos. Jeb, I was thinking here, the new condos there that you had talked about a few weeks ago, there's going to be $1.3 million around the corner from the office here with, connected to someone else, no yard. Well, there's that other lot there over there that they've never built on. And you look at it and say, I don't remember if that's a super fun site or they have to clean it up or what. But the thought is, well, they would always put in, 5,000 square foot lot houses to match everything around it. And you're like, if they ever build on it, we're only going to see more of this attached zero lot line, no lot properties, because we've gotten to a point where the land is so expensive that builders are going to shoehorn everything in there. But I digress a little bit from saying we have way more luxury apartments in Huntington Beach than we need. So I don't think that's all that different for the rest of the country. And it'll be interesting to see how that plays out.
All right, guys. So we are 25 minutes in. Josh and I have turned this live into a podcast. If you guys aren't familiar with it, in addition to actually doing weekly topics. So if you're familiar with the show, you know about the podcast. If you're not familiar with the show, there is a podcast where we actually every Tuesday we post you take a deep dive into a specific topic. And then every Friday we actually take this episode and take the audio and put it on podcast platform so you can listen to it, at your leisure, if you will. So if you haven't listened to it, check it out. And if you're listening now and you haven't already, hit the thumbs up, subscribe to the channel, leave us a comment, let us know what you like, what you don't like. We appreciate you being here. But Josh, we are at question time, my friend. So we're going to start at the top. Jay was here early, has a question for you, my friend. He says, when I bought my house, my realtor said my closing cost would be $17,000 and I would need $5,000 for a deposit. I put down the money expecting to pay $12,000 at closing. And at the last, I didn't get it. Oh, at the last minute, my lender said I needed 17 and the $5,000 wasn't included in that figure. Did he get screwed is what he's asking. Did he get screwed or did he misunderstand his lender?
Well, let's go back to put the first comment back up.
Oh, crap. I just got rid of it, bro.
Okay. Well, what you said there is that the realtor told you how much you would need at closing. So my first thought is that less experienced realtors will do things like tell you how much is. So Jay, were you actually saying that your realtor told you the closing cost would be 17,000 and you need $5,000 for a deposit? Never rely on the realtor. And that's not a dig at realtors. Jeb, would you ever tell the client how much they're going to need at closing? Or would you say, hey, we need to have a conversation with Josh and go through those numbers?
No, absolutely. I mean, I might say, give them an idea of where closing costs might be on something. But I would never tell them this is what you need. Absolutely not. No,
and
I don't even have those conversations, quite frankly, but
because there's nothing good that can come out of it for you. There's too many variables that you are unaware of. You know what they're planning to put down and you have a ballpark idea of what closing costs are. You don't know any number of things that could make that number vary greatly. So going back to answering the question, as a lender, we have to give you a loan estimate within 3 days of you getting that property under contract. The loan estimate sets tolerances. So if he gave you a verbal before sending that loan estimate out, then that was pretty foolish from the lender, he or she, to do. I would say, here's a very tight number. In about 24 hours, we're going to have the loan estimate out to you, and the loan estimate is going to give you a much better number. From there, when I say it sets tolerances, box A, anything that the lender or broker are responsible for is zero tolerance. Those cannot change between there and your closing disclosure as long as your rate is locked. If the rate's not locked, any points, the rate and points can change for box A. Box B and box C, depending on whether you can shop for them or not shop for them, they're either zero tolerance or a maximum of 10% tolerance. What they can do is they can screw up the stuff on the prepaids, but literally there's no room for a lender to screw that up. So what I would say is don't pay any attention to anything that does not match up to your loan estimate. That's the most important thing. And at the end of the day, I will give you ahead of the loan estimate an itemization of your closing costs and cash to close. And we always estimate them to the high side. This is all pure dual entry accounting, debits and credits. So if there's a debate, we can always go back to those numbers and go, here's here's what we estimated, here's what it came in at, here's what we estimated, here's what it came in at. And if it's off, it's pretty easy to isolate. And sometimes there's things that we didn't know. When the appraiser goes out to do the appraisal, there's no smoke detectors in, and there's a reinspection that's $150 to $200. Okay, we had no way of knowing that up front. There can be some additional inspections. The appraiser calls out the roof, says doesn't look good, we need a roof inspection. But again, all of those things can be isolated and matched up. It shouldn't just be me saying, oh, well, things change at the end. We should be able to take the initial numbers I gave you, look at them at the numbers at the end. But it sounds like someone, realtor or lender, gave you a verbal before the loan estimate went out, and the loan estimate was probably very close to your closing disclosure, and it was just something you didn't pay attention to because someone had already given you a verbal ahead of time.
All right, there you go. Run Raven says, just when I thought I was out, they pulled me back in. We have a tendency to do that. So if you want reliable information, if you don't, you can go to a lot of people out there, but we appreciate you being back. Carlos, get ready. BlackRock will buy every house in the USA to avoid the collapse. So I don't know that they're going to do it to avoid the collapse, but I bet you there's some cash sitting on the sidelines to buy property. In fact, I talked to a buddy of mine who does some wholesaling of properties across the nation. They buy properties in multiple states. Some states they fix them up and they resell them. In two, they fixed up in Georgia, I believe he said, and sold them to BlackRock. So BlackRock is still buying property, people. They're not, they're not gone.
Don't they know we're in a bubble and the values are going to crash?
Oh man, they're going to fall with that. They're going to collapse, Josh. That's you don't get it, and all that's going to be foreclosed property.
The Twitter,
you don't understand how this works,
and YouTubers have it figured out, but the hedge fund billionaires have no idea.
They no idea at all. Big G says when stocks go down. Big G was earlier talking about the recession, so we commented on that. So I'm not bringing that one back up. But when stocks go down and people are fearful of losing their jobs, they don't buy homes. People are feeling concerned about the economy and the energy cost. I would agree with that to some extent, and also disagree. I think they don't buy items they don't need. So they don't buy cars. They don't go out and spend money on ancillary stuff that makes no difference. People need shelter. So you either choose to rent or you buy a property. Now, maybe you don't make that decision if you weren't already in the process and now you're feeling the effects. But if you were a home buyer, what I will tell you is that when people decide to buy homes, the only reason they change their mind is if at some point they can no longer absolutely can't afford it, right? And I think you're giving way too much credit to people out there saying they have money in stocks. Josh, you look at a lot of people's finances. I don't know the answer to this. I'm going to take a bet that the majority of people buying homes don't have a ton of money sitting in a stock account. Maybe I'm wrong.
If they do, it's in a 401k, generally in mutual funds, and they don't know, they don't really have knowledge of it or understand it or look at it as real money. They think of, I need to accumulate money in there because someday I'm going to retire. They're not looking at that going, how wealthy am I? I mean, by all means, there's 100% a wealth effect due to retirement accounts and investments, but it's not what is being relied on the day-to-day. And let's look at this. We're coming off the Great Recession, short of the Depression, the Great Depression, the worst economy we've ever had, and unemployment peaked at like 10 or 11%. And go back and look at the numbers. We didn't have zero home sales that year. Home sales dropped 35, 45%, but they didn't go to zero. So to make absolute statements like this, yes, how do prices come down? There are less buyers and there are more sellers. But we've already talked about the reasons why we're not going to have a spike in sellers. We could have an increase relative to buyers, and people who are struggling, yeah, they're not going to buy. But I can tell you this, when I have a husband and wife, and they've been married 4 years, they both got raises, or are hitting a good point. Here's an example. A listener from the show that came through your lead form, Jeb, looking to buy here in Southern California. The wife just finished grad school. Husband has been on the job for 3 years, is making more money than he has. He's got some raises in commission, and they're getting ready to have a kid. You know what they want to do? They want to have a house to have that kid in. And they're not looking around and going, you know what, let's wait 5 years because the economy says it's a bad time. Some people will make that decision. Some people will have that decision made for them. So by all means, I'm not saying that you're wrong. I'm saying it's not an absolute. It decreases the relative level of demand in terms of buyers in the market, but it never goes away. It's there. It's just to a lesser degree. So like, I think we need to take this focus off this obsession and hope and prayer that home prices are going to drop a bunch, and realize that all the things we're talking about are much more likely to lead to a period of much slower growth. We've talked about 75, 76 years of 4.5, 4.7% home price appreciation. We just came off the two greatest years of home price appreciation ever. Is it reasonable to think that we revert to the mean and have 4, 5, 6 years well below 4.5%? I
No,
think
it has to crash.
it has to crash. It's the only way. It's the
I'm
only
kidding.
way it can correct, because I can't afford a house if it doesn't. So let's just think about how these things can play out, and why is a prolonged period of slower growth more likely than a crash? It's because of the strong hands in ownership right now. And that varies. So depending on where you are, if you're in a heavily newer construction, first time buyer, more affordable area, the homeowners in that area probably are not in as strong a position. But for us, like Jeb, I always use this example. In my neighborhood, prior to the crash in 2008, our home had peaked somewhere plus or minus $1 million. Was it a little over, a little under? I don't know, somewhere around $1 million. It never went below plus or minus $800,000. We lost 20%, and that's the biggest correction we've seen. And we've gone through the countless reasons of why that market is very different than now. But I'll give you the example of the first house that we flipped in 2008 in Anaheim. The gentleman had paid $665,000 for it, and we bought it for $265,000 less than 36 months later. And that was common in Anaheim. Why? First time buyers, entry level buyers, not as many people who had lived there a long time and built up a bunch of equity, the strength of the economy, and the people in those areas. So that's in our market here in Orange County. What is it, 12 miles to Anaheim from Huntington Beach? We're not talking about worlds away, but different markets, and they behave differently. So know your market, know what's happening, know what's likely. I would be stunned if we had a 20% correction in home prices for all the reasons we've listed. I wouldn't be stunned if we had 10%. I don't think that's going to happen, but that to me represents the worst case. I think it's likely that we have a prolonged period of sub trend growth, which trend for 75 years is 4.6%.
And also know that no one knows everything. All right. Josh and I read a lot of smart people, read both sides. In fact, I've been reading more pessimism lately than I have anything else. But even then, don't take our word for it. You have to make your own decisions at some point. Pony up, and not look for somebody to give you the answer that you have to hear in order to do something. At some point, it's the right time or it's not. And if it's not, there's nothing wrong with that, right? There, for a long time, it wasn't the right time for me. And then it was, and, purchased property. And I've owned multiple properties over that period of time. Some I bought at the top of markets, some I bought much less. So it's not always going to work out. But again, it's making the decision based on where you are in your life is always the right decision.
Jeb,
Yep.
let me, before we move on, one simple little thing here to point out. Most or many of the viewers, I would say more than 50% of you guys here are first-time buyers. Who is this knowing what happens next most important to? First-time buyers. For Jeb, who's thinking about moving up and buying another home, or anyone else moving up or moving down, it's not all that important. They're a homeowner. They're likely to continue to be a homeowner because most people don't go back to renting. Who this matters for is first-time buyers, and hopefully that's why you're here, to hear a perspective supported by facts and figures, and then exactly like Jeb said, to make your own decision, because as a first-time buyer, it is really important.
No, good stuff. Agreed. All right, so here we go. Gus says OC buyer, but waiting until winter. Good idea, or negotiate with current sellers. So here's what I will say. I don't know any other markets out there. I know my market well. I think the only benefit you have by waiting is maybe some more inventory, more options, if you will. And occasionally you might have a seller that needs to do something for one reason or another. Maybe they're moving out of state. Maybe they have another property that they've bought, whatever, and therefore may be more willing to negotiate than someone else. But I don't know. I don't think by waiting till quote unquote winter, you're going to see lower prices. Personally. So I think if you find the right property now, it's the right property today, you buy it today, versus waiting to see what the market does. I mean, I tell you guys every week, my wife and I are looking at property every day. If the right property comes up today, I'm buying it. and I'm keeping my current property, right? That's the goal, is to keep the property I'm in, buy another property. So, I mean, fortunately and unfortunately, the right property hasn't popped up. Unfortunately, because, we want to buy a property. Fortunately, because I don't really want to move right now. It has nothing to do with the idea of prices going down or any of that. It's just, I'm pretty comfortable. I like seeing money in the bank. I like seeing, dollar signs when I open up my account versus money going away in order to make transactions happen. So, and this has nothing to do with the stock market. I'm not even talking about those funds. So again, it's just, is it the right time for you? That's what you got to decide. So if winter's the right time for whatever reason, then winter it is. But I wouldn't be counting on much of a change other than maybe some more inventory.
Jeb, I had this conversation with a client for various reasons, for actually pretty good reasons. They want to wait till end of year, first part of the year, either one, but we're talking 3-4 months down the line. What are your thoughts on this? Historically, for us in Southern California, or California West Coast, where weather isn't an issue, you don't have snow sitting on houses in the winter, we see the majority of our appreciation from March, April through about August. It kind of coincides with that seasonality of all the people getting wanting to get the home purchased and into a home before the end of summer, before the kids go back to school. And then from August to about February, we see like a third of the appreciation we see the rest of the year. The last 2 years, all that seasonality has been gone. But right now for a buyer, what my feeling is on interest rates, until we see inflation come down, which is probably 2-3 months down the line at best, we're not going to see a big improvement in interest rates. We're also unlikely to see rates get worse because the economy is cooling. So rates kind of static, market normalizing, cooling, and heading into a portion of the year when we normally don't see a bunch of appreciation. I would normally tell people, as soon as you are comfortable buying, buy. The last 2 years in an incredibly hot market, buy as soon as you can, because prices are going to be higher sooner rather than later. But what do you think about the normal seasonality that we see and not seeing as much appreciation through the next 4 to 5 months?
I think that's reasonable. I mean, I think that's reasonable from a seasonality standpoint, but I also feel like that's reasonable because of just the slowing in the market, right? I mean, if you guys, a lot of you watch my videos in addition to this live, and I talk about that. I talk about the spring being the hot season. And when the spring is over, we get into this summer lull. This is normal. Now, what people don't remember, because maybe you're a first-time home buyer that started the process during the craziness, right? So if I'm going back prior to that, you have no recollection of that time. Therefore, it means nothing to you. And therefore, many people out there, you're wrong, Jeb, because that's not true. Well, no, historically, it is true. The summer isn't the hot season. The summer gets the credit for the work that was done prior to the summer. So the home that closes in July actually went into escrow in June, maybe even May, which is here for us in Southern California. The kids still aren't out of school in May. So that's still part of our season. Now, with that being said, people, once kids are out of school, they start going on vacations. They start doing things. Kids are in camps. They got to drive. There's a lot going on with regards to families and just transitions and what have you. And the reason that people don't typically do transactions, say once school starts back, for one, it starts to slow down. It's that time of the year when it does naturally slow down anyway. But if you have kids and you're in a school district, many districts out there don't allow you, once you move your kid in many districts, areas, you have to transfer to a new school. So people don't want to deal with that. Therefore, they want to be in the district prior to the school year starting. And so that's all part of that seasonality. That is what we're getting back to. Now, again, what you're reading or seeing is demand's dropping, pending home sales are down, mortgage applications are down, inventories climbing, the world's ending, we're having a recession, the Fed raised the Fed funds rate, blah, blah, blah. All of those things are true. But what you have to understand is some of those things were true in 2019, right? Before the craziness in the market, but you just weren't around then to see them. So just know we're getting back to a normal market. Like Josh said, we've 40% appreciation in a 2-year period. That is not normal. but people think it is because that's what they experience. And therefore, when it changes, it's all of a sudden, okay, well, the world's ending because it's not what it was. Guys, in order to get back to that trend line that we've talked about, a 4.5, 4.6% appreciation or 4.7, whatever Josh said, you've got to have some years of moving sideways to slightly up. And Josh and I had this conversation the other day. That could mean 10 years in some cases of little to no growth in house prices. So if you're a buyer out there, you have to take that into consideration, like real consideration, that if you buy a house today at say 300,000, I don't, if you can find one here in Southern California, you can't, but many markets you can, 300,000, that there's a chance in 10 years, you have very little appreciation on a property, on that property because of the sideways movement. Now, does that mean it can't go down a little bit and up a little bit? No, absolutely not. But the key is while you own that mortgage, you're paying down the principal on it, right? So on that $300,000 mortgage today, you're probably paying $500-600 a month in principal down on that property, which means over the course of, 10 years, well, Josh, I mean, I don't know, $50,000 you paid down on the mortgage. You could do the numbers quicker than I have. And you might look at that and go, whoo, 50 grand. Who cares? Well, beats the hell out of renting. But you got to make that decision, right? Again, I'm not here to convince you to do it. It's just, you got to factor all this stuff in and stop, hoping for the world to end.
I think you've done this before, Jeb, because you were almost dead on with the numbers. $49,000 in principal reduction. So let's say you got 1% increases on that $300,000. That's $3,000 a year. So in 10 years, it's going to go up $40,000, $35,000, and you've paid it down. You'll have $85,000 that the renter wouldn't have, and we would assume that rents would be increasing over that time where you have a fixed payment and the renter doesn't. So that's in a really extreme case. We're saying 1% appreciation for 10 years, and you never had a chance to refinance because we never had a lower interest rate environment. You guys, you're here watching because the majority of households in America want to buy a home, and they remain homeowners once they become homeowners. So that's not going to change. The entry points, the ability, the number of people that can do it will ebb and flow, and we may be at a low, and we may see some of the things that we're talking about. But just remember, like, hoping that something's going to happen, being mad that you missed out on the rapid appreciation of the last 2 years. I understand that. I would be mad also. You can look at our government's response to the pandemic and inflating home prices and be pissed that you weren't at the right point in your life to get in and didn't take advantage of it, or weren't able to take advantage of it. But that doesn't mean that we sit here and go, oh, you guys are idiots. It's going to be a total bubble. This is all going to implode, because everything that we're looking at says that's not the case. It's going to be something in between. Anyone telling you, hey, buy a house because they're going to keep going up 7% a year, 8% a year for the next 10 years, they're probably crazy. Anyone telling you this is a bubble and it's all going to crash and we're going to have people running away from their homes, they're also probably crazy. There's a wide range of potential outcomes, but they're all somewhere in the middle.
Agreed. All right, guys. So 45 minutes on. I'd like to ask a favor. Did you hit the thumbs up? Subscribe to the channel. Feel free to post a comment in there, get your question answered. Let us know what you like, what you don't like. As I mentioned, that little icon in the top of the screen there is a podcast. We take this, transcribe it to a podcast platform. If you search that, you'll be able to find it. There's a lot more information on there than just these lives, by the way. In fact, the information on there is much better than what we talk about here, because we take 20, 30 minutes and dive into a topic and try to go deep on it in order to help you become that educated home buyer. So if you haven't checked it out, check it out. If you like it, share it with a friend. There was someone in the comments a minute ago that mentioned that they have now turned their husband and somebody else on. I lost the comment, but I'll come across it here in just a minute. But anyhow, we appreciate you watching. We appreciate that support. So, all right, Josh, let's see. We got our youngest fan tuning in to watch the show. Born on the 21st. That's 6 days old. JD Homeboys in the house. All right. So awesome. We appreciate you, man. Thank you. All right. So Alex says Case Shiller for May showed a deceleration, but still crazy month-to-month appreciation, and rates were already 5% in April. Not true, by the way. If rates get back down to 5%, do you think? What do you think happens to prices? So I don't know that that's accurate on rates being 5% in April. Maybe they were at the end of April, but I believe it was around. Maybe you're right. I know around April, first week in May, interest rates were about where they are today, give or take a little bit. So maybe towards the end of April, we saw 5%. Josh, you can check it out there. But what do we think if rates go back down? Honestly, it's a scary thought, man. I I think we all, I don't know. This is hard to navigate because during the heyday when rates were at 3-4%, you heard Josh and I on here saying rates need to go up in order to cool the housing market, and it allowed supply to build. And we saw rates go up, and we saw supply building, and the market kind of went to a screeching halt. And it's like, do you really want this? I think from a long-term perspective, you do need rates to stay. I don't know that you need them at 6%, but I think you need rates somewhere around where they are right now to get more stabilization back in the market, to allow the market to kind of ebb and flow and allow those seasonality and those things, the cyclical nature of the market, to come back. I think if rates were to trickle back down for any reason at all, and I say trickle back down, I say if you were to see rates back in the mid to low fours, I think you'd see the market take off again. Now, maybe not what it was 6 months ago or 8 months ago, but I think you would see home sales go back up. You would start to see appreciation again. And now I'm not talking year over year appreciation, because you're going to see that anyway, but I'm just talking about appreciation from where we are today versus those times. So it's a scary thought to some extent, but I do think, rates could be, I think they could have already peaked at 6.25%. Now we're currently today at 5.5%. So does that mean rates can't go to 5.75 or 6%? No, it doesn't mean that at all. I just think maybe we've seen the high side of what rates are going to offer this year. And there's a chance that we stay around where we are now and maybe even go a little bit lower. But Josh is obviously the guru on rates, and he gave you his analysis earlier. But Josh, you want to touch on what you think happens if rates go down?
I want to share this, Jeb. This is what I was telling you about this morning. This is from Ed Pinto at the American Enterprise Institute. Not a fan of what's happened the last few years in home prices, and really just want to push here and kind of lead with what his thoughts are here. It says the Fed will need to hold the course on rates and quantitative tightening, meaning not reversing. So this came out this morning, knowing that the Fed was meeting today. They were going to raise 75 basis points. He was worried about what they were going to say. Well, Powell said we're nearing neutral. I believe they said they've achieved neutral on rates, and that they're nearing the end of the tightening cycle. What he's saying is rates at the 6% level are needed to slow year-over-year home price appreciation to 4 to 6%. This is someone who is an academic, economist sitting back. He's not a cheerleader for the market and pushing real estate industry narratives that home prices are always going to go up, or this is always a good thing, we want it to. He wants the Fed to keep their foot on the gas, raise rates, keep them up in that 6% range, and he thinks that's needed just to get us down to 4 to 6% annual home price appreciation. So think about that when there's other people pushing these bubble narratives with that. But in context of the question, we've already lost momentum because of affordability dropping due to higher home prices and higher interest rates. So it's intuitive to say, hey, if affordability improves with rates coming down, that we would regain that momentum. I think we would gain momentum. I don't think we would get back to the level of momentum we had. There's enough people who've kind of talked themselves out of it and gotten pessimistic. So if rates went down to 4%, I don't think you're wrong, Jeb, that it would be a positive. It would help activity in the markets. I know we would have a bunch of people coming back and doing cash out refinances, even if they have a 3.25 or a 3.5. Lots of people with a lot of debt they'd like to clean up and get their household balance sheets looking a little bit better, just in terms of cash outflow. So it really doesn't impact their balance sheet. You're just moving debt around that balance sheet, but increasing their monthly cash flow in their home. So it would help. I don't think it would make a huge difference, because once you lose momentum, it doesn't just come firing back in, and it's not going to improve affordability a ton from the point that we're at right now.
All right, good stuff. I'm going to jump around to some questions, some stuff that we don't typically hear, and then we'll try to get to all of them. But Sashidar, I have no idea. Sorry. First time home buyer here. I can buy a bigger house, but I want a 1-bedroom condo to keep my costs small and have smaller space. My realtor says it's a bad idea to buy a 1-bedroom. What is my opinion? So here's the deal. This is what we talk about often. Is that the right time property for you? Are you getting married? Are you going to have kids? Are you at some point going to need to sell that property and buy something else? And the reason I ask these questions is because typically 1-bedroom properties are harder to sell. Why? Less people looking for a 1-bedroom property, in my opinion, right? Those are properties that typically take longer to sell. They sit, they don't necessarily, I wouldn't say they don't get the appreciation that another property gets, but they're just less desirable properties just because, of the amount of people looking for them. So you got to factor that in. And I tell people all the time, we talk about resale on properties. Like I'll have a client that backs to a street and I'll say, just keep in mind you back to a street, if you don't mind, it doesn't, from that perspective, doesn't matter. But when you go to sell this property, you might have less interested buyers on that property, making sure you're aware of it. And people will say, I don't care. I want this property. And other people say, oh, I didn't take that into consideration. With that being said, I'll look at something else. I would ask you the same thing. If you still know that and think, I still want a 1-bedroom, ultimately you're the decision maker. You got to decide what's right for you. It's not the realtor's house they're buying. It's you buying a property. So if you want a 1-bedroom and that's what you have your heart set on, then buy a 1-bedroom. But just know, that when it comes to sell that property, you're likely going to be in a position where it's going to take a little bit longer and it might not be what you think it is when you go to sell it, just because of the amount of people looking for it. So just, again, I repeated myself about 10 times in that 2 minutes there, but I think it's important. Darren, long time, Darren. Haven't seen you here. Says, do you think home values will go down with this recession? Many people are predicting 10 to 20% home value decline. So we answered this in multiple ways throughout the show. I'm under the belief that you could see some slight declines with regards to home prices. Now, here's the deal. When you're looking at the Case-Shiller, you're looking at these year-over-year reports with regards to home prices, I don't know that you're going to see declines just because of how they do those calculations. Now, if you're asking me, hey, Jeb, there's a property that's on the market today, could it sell for quite a bit less in 6 months? I don't know, quite a bit less, but I think there's an opportunity with the market slowing, depending on what interest rates do and inventory does, that you could see homes move down. Now, I don't expect a crash. I'm not expecting 10%. I think 10% would be worst case. But I think a couple percent isn't crazy. Now, Josh is on the other side. Josh, what are your thoughts?
Well, think about this though, Jeb. What are we comparing it to? We always say that Case-Shiller is the gold standard because it's a paired sales index, so it's the same homes selling over time.
Yep.
When you look at things like when you see, oh, the median home price went up, the median home price went down, it's going to understate increases on the way up. It's going to overstate decreases on the way down. So we have a little bit of a data issue here because we've talked about this over the last few weeks. Really nice homes are still selling really fast at a premium.
Yep.
Moderate homes, depending on where they fall on that spectrum, if they're priced right, they're selling, and they may go for a little over list. They may go a little under list. But the properties you're talking about, I mean, we have a buyer that unfortunately she wasn't able to buy, but she kept getting beat out because she was in a very competitive price range. Jeb, you had to talk her out of writing an offer on a house that sited to railroad tracks. So homes like that, you're going to see price decreases. You want to offload those in the market that we had the last 2 years, and you don't want to own them in a current market like this. So again, all real estate is local. You have to know your market. Different markets are going to behave differently, and different properties are going to behave differently. That 1-bedroom condo, we've talked about the property I inherited from my dad. My sister and I own a 2-bedroom condo. That complex is all 2 bedrooms and 1 bedrooms. They're condos. Condos do worse in a down market. Well, in that complex, the 1 bedrooms do much worse than the 2 bedrooms in that down market. So it's all a spectrum. Trophy homes are going to do well, and in even a down market. So it doesn't mean that they go up when the market's down 5%, but it means they might hold their value, or they're down 1% when the market is down 5%. So big picture, could we see a 10% downturn? Yeah, and that would probably be, in the long run, a little bit healthier to sort of have this correction. But Jeb, let's follow it up, because this is a question here on the same road there. Delta Uniform Tango Charlie Hotel Echo Sierra Sierra wants to know, saw recently that median home price is 7x or 8 times the median income. If that is right, then it seems a hard environment to sustain. What do we mean by sustain? When you reach those levels, what we're really talking about is affordability is at low levels. That's a terrible measure of looking at home prices as a multiple of income, because it doesn't take into account the third variable, which is interest rates. So affordability says what percentage of households can afford the median priced home at current interest rates with X terms on the loan. And affordability is not at an all-time low, but it's approaching it. It's a low. So gains are not sustainable when you lose a volume of people able to purchase homes. We just have less able demand to continue pushing prices higher. So you can have a correction, you can have a protracted period of slow growth, and that's the most likely outcome for the next number of years. For home price appreciation to really take hold again, you have to have interest rates come down, or incomes go up, or a big decrease in home prices to get affordability back to the level where you have. So why people want to say, well, that's why we have to have a big decrease in home prices. Well, it's just not likely to come, because you're saying it doesn't seem sustainable. Well, why would someone sell their house? That's the question that you have to ask. People don't like being homeowners and then going back to being renters. So if you have a ton of equity, if you have a really low interest rate, if your payment is $1,000 or $2,000 less than it would cost to rent something equivalent, those people are unlikely to sell. So that tells you why, with home prices sticky to the upside, that we are more likely to see a protracted period of slower than trend growth to get back our affordability levels brought up than we are to see a big crash.
There you go. And I don't know why you just didn't say Duchess for her name. I mean, it would have been a lot easier than repeating the whole thing, but
I thought it was more fun saying the whole thing.
That's fair. Let's see. Nadine says, I'm seeing a lot of companies laying off remote workers as they are downsizing. Is that the start of a recession too? So Josh, layoffs, does that signify a recession?
It's a signal, and it's something that the Fed is watching. They're watching. They mentioned in the announcement today that they're looking closely at the employment cost index, which gets released Friday. So it's a different way of measuring. It's not the number of job openings or the number of people out of work. It's saying what it's costing employers to employ those folks. But it's certainly a measure that they're looking at. Anytime I see comments like this, though, it reminds me of, I'm seeing a lot of price cuts in my neighborhood. Unfortunately, or it doesn't even matter, you're going to make a qualitative judgment about it. Most folks do not have access to high quality, high frequency data that they could accurately say that. You've seen some news articles, you've heard anecdotally something about this. I talk to people often, and granted, it's survivor bias. I'm talking to the people who are doing well in their career because they're thinking of buying or refinancing a home, but I don't see it a lot. And people talk to me a lot about their job, their career, their prospects going forward. But again, there's some survivorship bias in that we're talking to the people who are in positive situations. I just question where the data is coming from. Again, I don't know anyone that reads more than Jeb and I do in watching this stuff. And the job market is changing, but I haven't seen that, and certainly not to the point to say I'm hearing remote workers specifically being laid off.
Yeah, there you go. I mean, I don't really have anything to add to what you said there. I mean, obviously, as the economy slows as a whole, you're going to see continued more and more companies lay off people. Even companies that may not necessarily be in trouble, just looking out with the idea that a recession is looming, right? I think many of these big Fortune 100, 500 companies know the idea of a recession is very, very likely, and so they're putting themselves in a position to prepare for that. So that they're not, working backwards at the time that, and trying to lay off people. So they're preparing themselves. So I think it's, a forward-looking indicator, if you will, as to a recession coming. But again, it's a lot of different opinions, a lot of different perspectives, if you will, as to where we'll be in a year from now. So we will be here, and we will let you know. So Benjamin says, housing market is in a transition point from wish pricing, which tend to sit, versus realistic pricing, which gobble up fast. How do you deal with homes with wish pricing? Do we just shoot our shot? So very, very good point. We've come out of a market literally where a seller could just name their price. In fact, I had sellers do it multiple times. And and I'll be honest, I told these sellers, listen, that's high. Like, I don't think that's a realistic price. And guess what? They got it. And sometimes they got more. And so I was at a point on listing presentations, having conversations where people said they want to list their price, asking me what I think about their price. And I say, honestly, like, I've been wrong several times. I mean, me saying that in a listing presentation, I've trying to be a little bit more conservative on the pricing, just because, again, I've been around this business for a long time trying to look at fair market value. And for a while, fair market value wasn't there. So people were able to get these crazy prices. And again, and many times they even sold higher than that. But what I will say is that when a property sells for more than the listing price, it was priced lower, right? I mean, it was priced lower than it should have been. I don't care what you say, that is the reality. Because if it was priced too high, it wouldn't have sold for more than that. So now you're at in a transition in the market, like you said, where there are many, many sellers out there that still believe that they're in that market for one reason or another, because they have a better property, because they have a better location, because you know they're the only one in the neighborhood. Whatever the reason, they still believe that they can get that. Therefore, you've got people still overpricing property, still seeing if they can get that price. Now, the question I ask you is, are they real sellers, or are they people just seeing if they can get their number, and if they get the number, that they'll sell and they're out of the market? That's what the difficult part is at the moment. And so as a buyer, that's what you've got to navigate. If you're dealing with a real seller, at some point they're going to have to adjust their price to closer to market value in order to sell that property. So if that's the case, shoot your shot, right? Why? Always shoot your shot. If that's what you want to do, you're not going to know without doing that. But at the same time, if they're unrealistic, which many sellers are, they're just testing the water to see if they can get it. Though they're not real sellers, and therefore they're not going to even consider your price. So it's a tough place to be. It's, from a buyer's perspective, and being able to navigate it. If you're one of those people, you can't be looking at comps from April, March, January, February, any of those, because the market was different then. Those properties went into escrow 30, 60 days prior to that date of closing, and the market's changed since then. But even then, I said this recently. I mean, my brother-in-law is looking for a property, and property was listed at 1.2. The agent on the other side was basing the sell of that property, in conversation. He was saying, hey, listen, the last one sold at $1,270,000. I'm thinking, dude, you can't use a comp that closed in February to give me an idea that your client's expecting $1,270,000 for that property, because that was a different market. Guess what? It sold pretty close to $1,270,000. Why? Because it was nice, because it was new construction, because it had the upgrades. It was the grays and whites. It was a beautiful property inside and out. Those properties are still moving. The ones that inferior locations, the ones that should have never sold at the premium price 8 months ago, a year ago, those properties are the ones that are going to be most affected. Those are the ones where you shoot your shot, you know, a little bit more aggressive on how you approach it, and hopefully you get the deal. So hopefully that provides a little bit of insight. But I don't know that there's not a steadfast way to approach each one of these, because they're all going to be different. All sellers are motivated by different things, you know, different emotions. And as a buyer and you know, your agent, it's trying to tie into those to figure out where's the middle ground. You know, there's always compromise. And so even in a changing market, yeah, it's less of a seller's market, and less, you know, sellers can get less aggressive, but at the end of the day, the sellers are the one that has the property that the buyers want, and it's not a full-on buyer's market at the moment. So there's still compromise on both sides. All right, Josh, let's see. I found houses in Southern California that are in location eligible for USDA loans. Our income is eligible as well. Why do lenders recommend we do conventional over USDA? So why would a lender recommend a a conventional loan over a USDA loan?
There's two reasons. One is their company doesn't offer USDA loans, or they're too dumb to figure out how to do a USDA loan. Those would be the two answers.
Well, there you go. So there, if you're in California, there's a little link at the bottom there. Check it out. Call Josh, and hopefully he can do loan for you. At least answer the questions for you.
Yeah, and honestly, seriously, so cool. Joe loan officer, Jane loan officer, please do a side-by-side comparison of a conventional and a USDA and show me why conventional is better. USDA, you can do zero down. I'm not saying zero down is the right answer, but for a lot of the first-time buyers, the biggest hurdle is the down payment. Flexible underwriting, it's good on credit scores. You can, even if it will appraise higher than the sale price, you can use that to cover closing costs. There's a million things that are really good about the program. And it's generally going to have lower interest rates and lower mortgage insurance than a conventional loan. But just ask them to show it to you side by side. And if you look at it and say, hey, a 3 or 5% down conventional is better based off of this, cool, jump in with both feet. But don't take someone's opinion. Generally, when they just fly off at the hip and say, oh, you want to go conventional, you don't want to do USDA, it's because they don't offer it, or they don't know how to do it, and they don't want to learn.
There you go. Good stuff. Let's see what we got here. Jessica asked, if rates go down, how much time does a buyer have to purchase and lock in a rate before they change further, Josh? So rates are changing every day, but like, I guess generally, what's your thoughts on this question?
I'm not 100% clear on how much time does a buyer have to purchase.
I think once rates go down and they see, hey, that's a rate that I can, how much time do they have to make that happen? I don't know that there's a steadfast answer. You could find a property that day and go into escrow and lock that day if you wanted. But typically things don't happen that fast.
Yeah, and you don't normally have a sudden drop in interest rates that reverses. I mean, you could have rates drop 0.25% and then that goes away next week. But if we're talking about if rates go from 5.25 to 4.25, how long do you have? I mean, that's not likely to reverse fairly quickly, because we've talked about this before. Rates come down slowly. For rates to drop 1%, we're probably talking about a 2-3 month process. For rates to go up 1%, we saw in the spring that can happen real quickly.
There you go. Miss Shannon's got a question here, needs some help. First-time home buyer, currently in escrow, supposed to close today, but trying to explain a 3-month gap from the pandemic last year. Any suggestions, Josh?
If we're talking about last year, we're in July of this year. So unless it was the very end of last year, you have 6 months back on the job. You're at closing. We shouldn't be explaining anything. I mean, in a 30-day escrow, underwriting should occur in the first 7, at the latest 10 days. So this shouldn't be something that you're explaining at the last minute, and it shouldn't be a problem. Even FHA requires you to have been back on the job 6 months, would be okay at this point, because we're 7 months into this year. So there's something there that doesn't add up. There's a bigger issue, something more that they're not telling you, and I can't give you a lot more guidance on that. An example, we just closed one earlier this week, an actual viewer here of the show that he's a server in a restaurant, and obviously in 2020 he didn't make a whole heck of a lot of tips. All of 2021 was pretty much normal. This year is even on a better pace. we had to explain why 2020 was so bad. And obviously, anyone with a brain, such as an underwriter, knows why it was bad, but we still have to document the file and say, hey, in 2020, for 9 months, the restaurant that I work at was closed and I was unable to work and was on unemployment. That's why I made $12,000 instead of $70,000. So that's generally what you're looking at, but it doesn't add up. That wouldn't be a problem. It's literally writing a letter in Word and putting it to DocuSign, and you should be done.
All right. So Shannon, if you have more specifics, reach out, try to help you. But honestly, just say exactly what happened and move on. And that's really it. You shouldn't have to go any deeper than that. Run Raven, run, Raven, run. Random but relevant question. In this market, should couples invest their money in buying a first home property instead of a full blown out wedding with fancy, expensive ring? Opinions, advice, thanks. So, Josh, I'm not going to jump on that one. I don't want to get hate mail from the spouse.
You want me to get it?
No, not necessarily. I mean, what's your idea? I mean, again, these are I get first world problem, if you will. If you're able to have a fancy wedding, expensive ring, your options to buy a house, are you prolonging the idea of buying the house by having this? What's more important to you? I mean, what I could tell you from experience of wedding is that it goes by quickly. I don't, for some people, it's an emotional thing, something they've always dreamed about, something that they look back on, and it's the best day of their life. I love my wife, love my kids. Could we have spent the money doing something else more fun? Absolutely. But it was not enough to buy a house either. So to each his own. You gotta have a happy life. So if keeping the wedding and the ring gets you that, then I say go with that. Otherwise, maybe consider the house. Josh.
The ring, some people would look at it as more crazy, but the ring is permanent. You'll have it in 50 years. Your grandchildren can use it for their wedding ring. A wedding is one day. It's funny. We were just having this conversation when my wife and I got married. She's from Washington. I'm from California. It was going to be like 50 something $1,000 to have the wedding here in California, and it was 30,000 to do it in Washington. So obviously we got married in Washington. Also, she has more friends than I do, so we had to have it in Washington. But
that's clear.
We were talking about it at the pool with some friends, and they were talking about like those numbers are more than double. And I'm sitting here going like, there's no world in which I would pay 65, 75, $100,000 for one day. Is it a memory? Is it really important? Yeah, I get it. Your marriage is probably the most important thing you're going to do in your life, other than having kids and raising them. I just for a day, for a memory, figure out a way to do it. Go to Vegas, go to a destination, get a few friends and family, keep it under 10 grand, and buy things that are permanent. It doesn't necessarily mean buy a house, but get assets and things that are permanent that hold value over time. And it's funny, there are people tell you no, it's experiences, and you'll see everyone says millennials are way more into experiences than things that they'll have that are tangible. So to each their own. There's not a wrong answer. I can just tell you where I come down on it.
All right, there you go. No hate mail, please. Anya says, are lenders eager to lend or more cautious these days, Josh? So back we saw after the last housing debacle, if you will, lenders got really tight on their guidelines, right? The pendulum really swung from one side to the other. We went from basically no underwriting on loans, no job, no income, no assets, to verifying everything, which is essentially where we are today. So are banks saying we don't want loans because they think the market's going down, or are we still seeing lenders out there wanting to lend?
So historically, we've seen the loosest underwriting guidelines right at the top of the market. So if you say the hottest part of the market, what would you say was probably January, February, March of this year? And we didn't see any loosening of guidelines. A good portion of that is due to the structural changes in the market that the government enacted. We talk about the bad things of the government. For the most part, the changes that the government has made to the mortgage market has improved it and made it more safe. If you look, there are companies that measure who's tightening and loosening underwriting guidelines, and it's been tightening the last year or so. So I don't see anyone getting looser, but at the same token, the majority of our loans are going to be underwritten to FHA, VA, Fannie, or Freddie guidelines. And other than some loan level price adjustments that Fannie has thrown out this year, making it more expensive to do certain loans, we haven't seen a lot of tightening. The tightening that we do see is in the automated underwriting engines. It's a black box. They don't issue, hey, this is what we're changing. We just know that version 10.2 is tighter than version 10.1 of desktop underwriter. And you don't really know why. You're just seeing, hey, this person qualified 2 weeks ago. Now we run them through and they qualify at a lower debt to income ratio. So if anything, it's tightening, but for the most part, I would say it's the same. We just have less people qualifying because prices are higher, rates are higher, and incomes haven't kept pace with it.
There you go. Let's see what we got here. So Josh, um, how easy, hard is it to assume a seller's loan with a lower rate? So maybe you can explain what assuming a mortgage is, and then talk about if there are options out there to actually do that.
So let's say when it was really popular in the early 80s, lenders had not the law didn't support a due on sale clause, meaning that when you sell your house, the mortgage is due and has to be paid off. So at that point in time, sellers who had 5, 6, 7% interest rates from the 70s were selling their house, and maybe they bought their house for $40,000. And now that house is $55,000. A buyer would come in and say, hey, I'll take your 7% rate instead of the current 18% rate, and I'll get a 20% second for $10,000, and I'll put a $5,000 down payment. That's the why. Well, sometime it was 82, 83, 84, lenders lobbied the government to allow them to put in a due on sale clause that says if they have the due on sale clause in your mortgage documents that you sign, it's a default on the loan if you sell the property and don't pay off the loan. So there are a couple of exceptions. FHA loans allow assumptions. VA loans allow assumptions. The biggest problem that we have right now is the scope of appreciation for most people. So let's say you want someone's 2021 loan when they bought, that home's gone up 35% in value. If they bought a $200,000 home, it's a $300,000 home now. So those assumptions have to be approved by either FHA or VA. For the most part, you just qualify as the same as the FHA and VA guidelines. You just have to come up with the difference in funds. And with an FHA loan, you're putting $100,000 down and you have a 2.75% rate, but it's got 0.85% mortgage insurance. So it's really 3.5. VA is more attractive from that perspective, and conventional loans are just going to have to be paid off. And 99% of all portfolio loans, meaning from a bank or a non-QM lender, hedge fund, that type of stuff, is also going to have a due on sale clause. So I have not seen them come up in any way, shape, or form, even though they technically are possible.
There you go. Appreciate that. I got Big Fish saying, is it better to buy a house all cash or take out a mortgage? Do you think there's a better type of loan instead of traditional conventional financing? So the last part of the answer, I think, is no, for me at least. Cash or take out a mortgage. If you have the ability to pay cash for a house and that doesn't leave you cash poor, why not? But at the same time, I believe in leverage. Excuse me. What do I mean by that? I mean, putting the least amount of money down where you can feel comfortable with the mortgage, and maybe using that additional money to make you money somewhere else, right? Because you're still going to get the same appreciation in that property, whether you pay cash for it or whether you pay cash, whether you get a loan for it. The only difference is you're paying interest on that mortgage. Well, if you can find something that pays higher than the 5% or so that you're going to get today with regards to that additional money that you have out there, then I think it's worth considering putting it in something else. And it's always nice to have cash. I mean, there's opportunities. What are you going to do when the market crashes? How are you going to buy a house if you don't have that cash? I'm kidding. But no, seriously, like if there's opportunities in the market, something presents itself, having that cash allows you to take advantage. Now, if you're in a position where you'll still have that cash and buy cash for a house, by all means, pay off the mortgage. I'm not a Dave Ramsey believer where I don't think you can't have any debt, right? I think having a mortgage is a reasonable debt to have, assuming it doesn't affect you in other areas of your life. Josh, anything?
No, I'd say the same thing in terms of other types of loans. Really, it doesn't matter. A conventional loan typically means loans underwritten to the Fannie Mae, Freddie Mac guidelines. a fixed rate loan is a fixed rate loan is a fixed rate loan. So whatever has the best combination of low interest rate and low costs is going to be the best loan. Is it better to buy all cash or take out a mortgage? It really just comes down to what you're going to do with that money. Some people are more comfortable not having a payment and giving up the money. Other people are more comfortable having some of that money as a cushion.
All right. Don Draper says, can you talk about Cal Haffa? I don't see a lot of content out there about the program. Is it worth exploring? So for those of you who aren't in California, don't understand what's happening here. So Cal Haffa is really the only down payment assistance program in the state of California for the most part, that's still lending money. And even then, I don't know that they're lending money. So Josh, maybe give a quick overview of what Cal Haffa is, how you use it.
You can use it with a conventional or an FHA loan. You're getting the loan through Cal HFA. They're doing the underwriting and they're making the loan, but you're still going to go through a broker or a bank that offers it through Cal HFA. It's going to have higher interest rates than what you can get on the open market. It's going to be have a higher credit score requirement. It's going to have income limits. It's going to have a lower debt to income ratio, and it is not free money. So it's going to be a second mortgage of either 2 or 3% of the purchase price, and usually another third mortgage. So the only good thing about the program is you can get into a home with no money out of pocket. It's going to be less than what you could qualify for otherwise, and you're going to pay more for it, both in terms of closing costs and interest rate. So I look at it as a spectrum of, hey, I have no money. I can't do a 3.5% down payment or a 3% down conventional and get a seller credit or a lender credit for closing costs. So my option is either don't buy or go with Cal Haffa. I would probably recommend going with Cal Haffa, but especially in the current market, it's something to be wary of, because if you're thinking home prices might dip from here, you're at 102, 103% loan to value the day that you close on that loan.
Yeah.
You need the appreciation like we've seen the last few years to get your head above water.
Yeah.
Another negative about it, Jeb, they won't, if the value goes up and rates come down, they stopped about 2 years ago approving subordination. So if you have that second and or third mortgage,
You got to
they won't
refinance
let
it.
you refinance the first if you don't pay off the second and the third.
No, good to know. And the other thing, I mean, the one thing I remember about Cal Haffa, and this might not be true today, because it's been a long time since I've come across one of these, is that they typically take quite a bit longer to close because of the approval process. So instead of a 30-day escrow, you might be looking at 45, 60 days. Now, Josh, you can tell me if I'm wrong there on that. But are timeframes still drawn out on those because of the approval process, or is it
It's
streamlined?
definitely longer. If you were dealing with someone who's experienced in doing these, I would think 30 to 45 days would be reasonable, but that 17-day, 21-day close is probably not something you're going to be
Got it.
looking at.
And honestly, like in some markets in California, you might be able to do these. I don't know. The majority of these markets, I think you still might have a tough time using Cal Haffa just because of, it's still, unless a home's been sitting and overpriced and what have you. I don't know. I just think it might be a little bit tougher. So anyway, Rianu Keeves is asking if he is done. Had an opportunity to lock a rate at 4.75 in April, didn't pull the trigger. Josh, thoughts on maybe, property closes mid-December. Consider locking that loan now, today, or gambling, baby, rolling the dice.
Well, again, whenever I answer this question, I always am inclined to say, what would I do? Well, what I would do is different because I watch this stuff every day. I have 2 screens up showing me what's happening in bonds all day. I have 3 or 4 different people that are amazing analysts telling me what to think, what to look at, what's likely to come next. And I believe rates will be lower in December than they are today. That's not 100%. So can we bet on it? Can we guarantee it? What I would look at doing, if you probably had to get pre-approved with the builder's lender. If the builder's lender is offering long-term locks, like most of them are, because they don't want fallout because people don't qualify at close of escrow, find out what they can do for you in terms of a long-term extended lock. And then if rates are better, check with a backup lender if they don't have a good float down policy, and be approved with another lender and ready to lock sometime in November, December.
All right. So, guys, been on almost an hour and a half, asking a favor to hit that like button, subscribe to the channel to stay updated on everything real estate mortgage related. We appreciate you being here. There is also a link scrolling at the bottom now. If you need to get connected with a mortgage professional, need to get connected with Josh, maybe looking for a real estate agent in your market, go there. Happy to make that referral for you to an expert that we know, like, and trust. That'll take care of you, guide you through that process, at least get you the answers you need so you can make informed decisions. So with that being said, Josh, I was going to ask you a question and I completely forgot what I was going to say. So let's just disregard that. People, viewers, 127 likes, 128 likes. Can we get to 200 by 2 hours in? We got 30 minutes. Let's see if we can get there with some support. And lastly, if you want to get in touch with Josh, I'm going to throw something else up here on the screen. Many of you guys are out of California, but want to have that, that consultation, if you will, to see if you're making the right decision. You have mortgage questions, all that stuff. So that right there will get you in touch with Josh and myself if you want to have that conversation. So Josh, let's go up here. I'm going to answer this question quickly and then we'll move along. But D Terminator says, how much lower of an offer can you make to a seller with wish pricing? Is it up to 10% considered? Is 10% reasonable? It's going to depend. What are we talking about? What is wish pricing? Is that 5% over? Is it 2% over? What's the number? Right? I had somebody call me today, an agent. I have a property listed. It's been listed for a little bit, and it's listed at $1,300,000 something, $1,375,000 ish. And the agent told me her client wanted to make an offer at 1.2. I said, don't even worry about it. Save yourself some time. Go on the beach, go to the pool, have fun. Instead of writing that offer. Why? Because the home is worth more than that. The comps around it support it. The ones that are selling today support a value much higher than that number. Now, does it support our number exactly? Hard to say, but it doesn't support anywhere close to that. Now, you might say, well, Jeb, open the negotiation, have the conversation. That you can't, negotiate without an offer. Very true. And we had that conversation as well, but just, we're not, that was a 1-2 offer. So that was $175,000 lower than our asking price. That's over 10%. I mean, I don't feel like that's reasonable. That's offensive in many ways to clients. I don't make that decision. I'll present every offer, but I can just tell you from experience, we're not at 10% below asking prices. And with a client that has wishful pricing, they're already unreasonable people. Maybe because of their agent, maybe because they're unreasonable in setting that price themselves. But when you come in 10% less, I can tell you initially, unless it's been on the market forever and multiple people have done it, they're still not going to believe that price is 10% less unless they have to do something. So it's not, this is where the market's a little bit tougher to navigate because, each seller is going to handle it a little bit differently. And a lot of it has to do with what they're being told from their agent, what they're being told from people around them. All of that stuff plays a part. So I'm not saying you don't do it. I'm just saying don't expect to go in and just all of a sudden somebody accepts it. Expect a negotiation.
I think the important part that you said there, Jeb, is if you think it's worth 10%, go in with facts that.
Oh, absolutely.
Yeah.
Like where are you coming up with your number?
Yeah.
Yeah, bring it to me and I'll happy to present it.
Otherwise, you are guaranteed to offend the person. They've told you what they think their house is worth. And if you're going in at 10% less, when the comps support their opinion, you're just going to piss them off. If you seriously want to buy the house, if you're just bottom fishing and hoping that someone might take a lowball offer, that's one thing. But if you actually hope to buy that house, I wouldn't irritate the seller.
No, absolutely. I mean, it's like Courtney, who works for me, has a client that's submitted a couple of offers. All less than the asking price on every property that she wanted to write an offer on. The most recent one, the property was priced at $725, I think. They made an offer for $709. Fortunately, we knew the agent. Agent came back and basically said, we're giving you an opportunity to come in with a higher price. We have multiple offers. Basically, kind of having an idea that we need to be at the asking price. Client says, no, I'm going to stick to my price. Okay, guess what? They didn't get it. So even when you're handed these opportunities to be competitive in this market. There's people out there that think they know more than what the market's doing, and therefore that's the, you got them on both sides, the wishful thinking on the selling side and the wishful thinking on the buying side. So it's going to take some negotiating on both sides mentally in order to come to an agreement on some of these things. But whether you can, or you think you can, or you think you can't, you're right in these environments with making these offers. So just know that the market hasn't fallen apart, people. That's what we're trying to get at here. Josh, are Heloc loans dead?
People can't be talked out of them, essentially. This is what I've been telling them all year, that we know the Fed is going to have to aggressively hike to combat increasing rates. So you can look at it and say, I have a great interest rate on my first, I need some cash, I'm going to take this Heloc. If it's a $25,000 Heloc, do you really care that rates go up 2, 3, 4% on it when you have a fantastic rate on your first? Not so much. But we've had clients with a little tiny first wanting a big amount of cash. I had a client last week that we're doing a refinance. I really don't want to pay off my second. Why is that? Well, the rate and payment are really low. It's an interest-only payment. The rate was low. I said, hey, pull out the loan docs. Tell me what it looks like right now. He's like, oh my God, that rate's gone up a lot. Most people don't look at it. They just watch the payment, usually an auto payment. So because a lot of people are looking for small second mortgages relative to large first mortgages at really low interest rates, they're not dead. But I think people are kind of shocked at seeing what the payments look like with prime now at 5.5. Most margins are somewhere around 1 to 3% if you're less well qualified. So you're looking at 6.5 to 8.5% on that second. But it does have an interest only payment, and it really comes down to how large the Heloc is relative to the first.
There you go. Good stuff. I saw a comment here that I wanted to get into, and now I don't see it. Josh, why does that happen? Why does that happen? It was asking about condos versus townhomes.
Go find it. Let's just answer. I'll answer this one real quick while you're looking.
All
Don
right.
Draper back again. What's the best online tool to find out how much house one can qualify for? I'm in California. I just want to get an idea of what I can afford without having to commit to anyone or anything. There's no online tools that are going to get you in the ballpark. All of the online stuff, you're not going to get an accurate calculation of your income. You're probably not going to get an accurate estimate of the taxes, mortgage insurance, if there is mortgage insurance, and it's going to use old and outdated estimates of what your debt to income ratio could be. So I get it. Everyone wants an awesome deal and they don't want to deal with a salesperson. Don't call a place where you're likely to get connected with a salesperson. I said earlier in the show, we talked to a couple today, got them pre-approved. They're not going to buy for 4 to 6 months. We're not going to sit here and pressure them to buy today. We're going to arm them with all of the information that they need to know and plan where they're at. Because for them, 4 to 6 months down the line is the right time for them to buy. But they still needed to know today where they're at and what they need to work on and correct and put in place between now and when they buy.
All right. This question to SSRS: opinion on acquiring a townhome versus a single family home as first purchase for a real estate investment. So, here's the thing. Each have their pros, each have their cons. Instead of diving deep on this, we recorded a podcast on this. In fact, I don't know what episode it is, but it was recorded on June 14th or put out on June 14th. Go and listen to the pros and cons and make the decision based on that, right? Condos are going to have some additional fees with regards to owning them. They're going to be less expensive, typically, less maintenance, typically. So you've got to decide from an investment standpoint which is better for you. It's, we go over all of that in there, but, go to the Educated Home Buyer podcast and check out that episode. It'll be a deeper dive than I can go on here tonight and hopefully answer the questions to help you make the right decision.
Jeb, maybe in like a year or two, when we've answered every question on the podcast, we can just program 2 AI bots to sit here and just answer questions. Okay.
I think at this point we could,
X,
if we had all of the questions somehow categorized, we could literally just sit here and click a button and the answer would come up. I mean, I'm pretty sure we've answered close to every single question you can have.
Get one of those big stream decks with all of them queued up and just push the button.
To hit buttons. Let's see here. So Josh, a lot of people are priced out of the market wondering what to do for one reason or another. So I'm not going to, all these are different variations of the same question. Wife's credit score is low. Lender suggested just to use my income and score to get a better rate, but the loan we were quoted can barely get us a decent home. What should we do? 23-year-old here, want to get a house with two of my brothers. We all have full-time second source of income. We've all agreed to split the bills evenly. Should I pull the trigger or just rent instead? It's all about buying a property now versus waiting. What do you do, Josh? I mean,
Well, the one wasn't so much about waiting.
yeah, I guess those two aren't exactly the same here. I clicked on the wrong one, but you get
So
the idea.
if you have a spouse or a co-borrower with a much lower credit score, it's great to say, hey, just leave them off. If you have, because you'll get much better terms. But if you don't qualify for a home that's going to make you happy, that's a terrible idea. This is a big and long-term investment. So quantify it. Show me, Mr. Loan Officer, Mrs. Loan Officer, what does it look like with both of us? What does it look like with one of us, and how much different is it? What kind of a premium am I paying? And then more importantly, go through that credit report and fine tooth comb it. Do a what if analysis. Are there things we can repair, improve to get it over a 640, to get it over a 680, to get it over a 720 in a short period of time to make it make sense? Those are the things that I would go through with the client versus saying, her score sucks, let's just go with you. And you can buy a double
Yeah,
wide.
a lot less work. I mean, maybe you want to spend the time and work on the credit, is probably the best advice, versus buying a house that you don't really like. You can get your credit score up pretty quickly. 30, 60 days can make a huge difference in credit score. And honestly, I don't think waiting 30, 60 days is going to kill you in this market, right? I mean, probably presents more opportunities out there than anything else. So I would do that and then maybe get back in the market with a higher credit score.
Jeb, you're dead right. And the fact, Ed, that you have good credit tells me that there's someone disciplined in that transaction. What I will say, we talk to people all the time. I have a great credit repair company. When people do what they tell them to do, 90 to 180 days, we see 80, 100, 150 point turnarounds in credit scores. What most often happens is people pay them their fee monthly and don't do at all what they're supposed to do. They're not paying debts down. They're not opening the new cards. They're not doing anything that they're supposed to. And 6 months down the line, scores are the same or even lower, and they've paid someone $700 to $1,000. So know yourself and know your discipline. It is absolutely possible, just like Jeb said, to improve your credit score a lot in a relatively short period of time.
Now, I lost the question earlier, Josh, where I was asking, or where they ask, multiple roommates buying a property together. Should you buy now? Should you wait? So, when you're thinking of buying a property with multiple people, combining incomes, combining down payments, kind of going into this process together, is what are your thoughts on that? I mean, this market, any market, it's
My father-in-law has a saying, you only take on partners when you have to, otherwise you do it on your own. Sounds like in this situation, to do something right now, you have to have the partners. These partners happen to be your brothers. Jennifer pushed back on that. You asked and answered a few questions saying, hey, we've lived together before. We get along really well. That's not a guarantee that there's not going to be any problems going forward, but go into it with eyes wide open, have really clear agreements. Think of everything that could go wrong. What if someone gets married? What if someone has financial problems? What if someone just wants out? What are we going to do in every potential negative outcome? But if you've thought everything through, I wouldn't not buy with partners if you're going into it with eyes wide open.
good stuff. So hopefully that helps you there. Shripal, statistically speaking, is there a chance of getting home prices back down to pre-COVID levels? Many stocks are at that level now. So the stock market is not the housing market. We talked about that earlier in the show. The two don't operate the same. The two don't follow each other with regards to, decreases percentage wise, anything like that. So Josh, let's answer the first part of the question. Do you think there's a chance, I mean, statistics, not statistics, that prices get back down to 2019 levels?
If you watch a game on the little ESPN Gamecast or whatever they call it there, it's predicting at every point in the game the odds of each team winning. And at some point in the game, it will get to 0% chance for one of the teams. I wouldn't say there's a 0% chance, but what are we, 0.1, 0.01? It's a very, very small chance. We're talking about what, 15% plus and 15% plus, so cumulatively close to 35, 40%. I don't see a world like we saw that in 2008 in the worst areas, down 35, 40, 50%. And that's like was the perfect storm for price correction. So could it happen? Yeah. Do I see a reasonable path to it happening? No, I don't.
Yeah. Is there an opportunity for that to happen? Sure. Black swan event, something nobody's predicting. Um, Possibly. The likelihood of it happening, I don't think is very high, just because, again, of where we sit still with inventory, with demand. If home prices were to decline, who jumps in there and becomes a home buyer? Who started the process, got priced out, but still really wants to own a home? There's a lot of those people out there. It doesn't go away. Once you've decided you want to become a homeowner, chances are you don't just decide that you're going to rent forever at that point, unless something changes in your life. So I think, if prices were to pull back significantly like that, you got people jumping in to buy property, which is keeping it from ever getting down there. But again, I don't think that's an option either. So just our thoughts. You can find people out there that would say otherwise.
We have a couple
Yes,
of them
you
that will tell
can.
you all day, every day that it's coming in the next
Yes, you
6 weeks.
can. Idiots. Let's see here. There's a lot of variations of the same. Okay, here's one. JT Owensby says, pretending a buyer is a few grand short of buying with no family to help. What method should be looked into to cover the difference? So if you don't have the money to close on a property, are there opportunities out there? If you don't have family to get that money, can you borrow it from a bank? Can you take a loan? Like, are there options, Josh?
Let's go through, just throw them all out there. Unsecured borrowed funds, no, those are not an acceptable source of funds. But if you took unsecured borrowed funds in 60 days of it sitting in your bank account, no one knows where it comes from. You just have a loan on your credit report and you have the funds sitting in your bank account. So that is an option in the longer term, not in the short term. You can get a second job and save some money, and we can show, even though we can't use the income from the second job that you've only had for a few weeks, we can certainly use the assets that you've pulled from it. You can borrow against things. Let's say you have a free and clear 1969 Camaro sitting in the garage. You probably don't, JT, but if you did and you want to go get a $10,000 loan against it, secured borrowed funds are absolutely possible. Really, those are the big things. We can get a seller credit. We've talked about that wasn't a thing. Now, recently in the market, absolutely a thing. If that doesn't work, we can get a lender credit. There's a reason why lender credits are not as attractive right now, with rates elevated and lenders believing that they will moderate and go lower. They don't want to pay premiums to put higher rate loans than the market is already at on the books. So you have to go really high to get much of a lender credit. But thankfully, that's where those seller credits come in handy. Anything else that you can think of, Jeb, that I'm leaving out here?
No, not really. I mean, that's pretty much nails it. In fact, I mean, there's some in there that I wasn't even familiar with. So I
Anya
don't,
had mentioned
yeah.
the 401k withdrawal or loan, and the reason why I didn't throw that out there, I actually talked to JT a few hours ago, and we went through that one. So yes, a 401k balance, you can do a withdrawal. We've talked about this 100 times on the show. I hate that idea. You will get taxed and penalized, but a loan absolutely makes sense. You'll repay yourself in a relatively short period of time.
Good stuff. Run Raven. Again, I'm just making up the Raven part. I'm not sure. Are agents obligated to reveal all better offers if requested from another agent? No. We are actually aren't obligated to show anything to another agent if requested. So, can you, as an agent, disclose the information? Sure, it's not really ethical in some cases to do so. Yeah, so we don't really reveal where other. Now, what I will do is once I go into escrow, I will let the other parties know where we went into escrow, price wise, down payment wise, why we accepted an offer, just because I think that's helpful and informative to the other agent of why their offer probably didn't get accepted, and maybe help them in writing other offers in the future, help their buyers understand the market that they're in. But no, we're not obligated to show any other offers. Josh, we got Richard here, owns a house in the Dutch Haven track. That's here in Huntington Beach. For those you don't know, I'm sure other markets have them as well. Wants 1.2 million, still up for sale, been over 3 weeks, open houses every weekend. Guess what? That house is probably 1,200 square feet. That's why it's not selling at 1.2 million. It's crazy. It's priced too high. That's why it's not selling. Otherwise, it would have sold by now, because those are desirable homes, but not at that price.
Well, it's funny, Jeb. The neighborhood behind mine is all Dutch Havens, and my wife and I walk back there, and it's amazing. In the 60s, when they built them, you knew it was a Dutch Haven because it looked the little Dutch elements they put on them. Now, I'd say 60% of those houses have been de-Dutch Havens. They don't, you wouldn't know it unless someone told you, or
Yep.
you saw the third house down the way that, oh, okay, yeah, I see it.
No, absolutely. Let's see here. Um,
Jeb, you might not find this question as interesting as I do, but I want to hear your answer to it.
mhm.
Jeff says, when pricing a home for
Yeah.
sale, how much value would you attribute to a 2.25 VA assumption in and of itself? I'm going to preface it before you answer that by saying it may not be as valuable as you think, because there aren't a lot of people that can put that amount of money down. If it's appreciated $100,000, $200,000, someone may not have access to that. But assuming they do, a 2.25 30-year fixed rate in a 5% market, 5% plus market is pretty attractive. How would you go about valuing that?
Well, I look at it like this. If I'm a VA buyer and I have options to VA financing, there's really high likelihood, and this could very well not be true, that I'm not putting or don't have the money, or the assets to put down for a down
Hold on,
payment.
hold
Yep.
on, Jeb. A non-veteran can assume a VA loan.
A non-veteran can assume a VA loan. Okay, wasn't aware of
So,
that.
so that changes the
Um,
calculus there.
yeah.
It's
So
very rare and
right.
unlikely, but they technically
Yeah, so
can.
so you got to think. So when you got that 2.25 loan, on a VA, I mean, house prices were significantly less than they are now because, I mean, of where the market was at that time, right? So any buyer coming in has got to put down that difference, in order to, plus whatever you're asking over and above, because you have this VA, loan, that's assumable in there. I don't know. It's honestly a difficult question, and one that I'd really have to take some time to consider. I don't know if I can rattle off an answer, um, right
It's a
off the top
tough
of my
one
head.
and an interesting one. Let me
It,
offer this to you,
yeah.
Jeff. I'm not sure if I were a seller, if I would have to get a lot extra money to be willing to allow a non-veteran to assume my VA loan, because your entitlement will not get restored until that loan
No,
is paid
interesting.
off someday. So, unless you're comfortable with your entitlement being stuck with someone else on that home, you can still get released from liability on the loan with them assuming, but you can't have your entitlement restored until that loan is paid off, which would prevent you from using it to purchase another home. So be super careful, because I don't know that you would get a huge premium on the home for it.
And that's the thing, is like, you again, it's like, what are you trying to get from allowing someone to assume it? Are you trying to get a premium on the property because of it, or are you just trying to sell it quicker with the idea that you have this assumable thing? I honestly don't know. It's I think it a lot depends on the property and the market that you're in, and a lot, but I really need to put some thought into that. I mean, it's not something I've ever considered. And quite frankly, didn't even know you could assume a VA loan if you weren't a veteran. So a lot of moving parts there, but, yeah, if you need an agent, that can help you with that, let me know, and I'll point you in the right direction. Josh, is an FHA loan a good idea, bad idea?
First off, if I'm seeing what I think I'm seeing, this might be my new favorite little avatar
A
picture
picture
there.
of a picture on your
Does
head?
he have a tattoo on the side of the head with a mohawk? I like that. It looks like a tattoo of a mohawked him on the side of his mohawked head.
Maybe it's really somebody that's good at cutting hair and they just etched that into his head.
That's even better. If someone had the skills to carve that into his hair, that's fantastic. But let's get back to this. Jeb, you and I talked about this earlier in the week. FHA loan. If you mention it to people, you get polarizing responses. Half of the people tell you never do an FHA loan. It's the worst thing in the history of the world. Half of them will tell you do FHA. It's the best thing. It's the greatest. The answer, as always, is
Somewhere in the
somewhere in
middle.
the middle. For some borrowers, it's far and away the best route to go. For others, you would kind of be dumb to do it. We have some people from the show that bought last August, and we originally thought we had to go FHA. When we got all the documentation in and we looked at it, they were able to go conventional. Husband and wife, 2 borrowers, both of them credit scores above 760. The conventional loan has slightly higher interest rate, but much lower mortgage insurance. So the 3% down conventional had lower cash to close and a lower monthly payment. So we always go back to numbers never lie. Assuming you qualify for FHA and conventional, pencil them out side by side, see which one has the lower payment, which one has the lower cash to close. And something that most people don't take into account with FHA loans is it's not just the monthly mortgage insurance, there's an upfront mortgage insurance premium. So even though you're putting 3.5% down, you're financing 1.75% back on top of that loan. So you have less equity than you would have with that 3% down conventional. So talk to someone trustworthy that's an advisor and not a salesperson and can pencil those two out side by side and go through the pros and cons with you, because there's not a definite answer that one's better than the other. They both have a time and a place, and they both can be good options.
And one thing I will add to that is that in this market that we're in now, the shifting market, homes are sitting a little bit longer, more options to choose from. FHA loans aren't what they were 6-8 months ago. And the idea that everybody looked at an FHA and said, there's no chance the seller's accepting that when there's this much activity on a property. Some markets are still like that, right? Where there's multiple offers and maybe the FHA loan's not considered. But if you're an FHA and you're the only loan or the only offer on a property, guess what? Seller's probably considering it. So that's changed over, with this change in the market. So just keep that in mind. And FHA loans, like Josh said, aren't bad. You just got to know what you're getting into. You got to understand the downsides of them, and still be able to decide whether or not it's right for you. Hopefully we see some changes on FHA in the next couple of months with regards to mortgage insurance premiums and that sort of thing. Josh,
So
what are your thoughts on that?
we have some friends that are very well connected in Washington, D.C. I've got a buddy, he's an older gentleman, retired. He used to run all of lending for Wells Fargo, very tightly connected in Washington, D.C. He's told us it's been done for months. Why they're not announcing it or when they're planning to announce it, who knows? So we
And when
should
you say
see
it's been done, what's been done?
a decrease to mortgage insurance premiums, and most likely the upfront mortgage insurance premium versus the monthly.
And is that retroactive for people that have FHA loans or just going forward?
Loans going forward.
Okay. Yeah. Good stuff, guys. Obviously, we'll update you if that changes and keep you there. Now, this is not a plant by any means. It may seem like a plant. It's not a plant. Kathleen says, I'm a home buyer. What is a rate buy down? Kathleen, you're in luck. We posted. Did we post it or is it next week? When's the rate buy down episode?
I was gonna grab it here real quick.
Hold on, Catherine.
I think it was last week. It was last week.
Was it?
Yeah, because this one no, you are correct. Well, we did record it Monday. Did you release it Tuesday?
Hold on, I don't know, man.
You'd think these two would remember what they did on Monday. It was 48 hours ago, but hey.
All right. Yeah, it's released. So we released it on Tuesday of this week. The last episode on the Educated Home Buyer podcast is on buy downs. What is a rate buy down? In this one, we talk about what is a seller buy down. And then if you go to episode like 6 or 7, we actually talk about, different types of buy downs or discount points or what have you, depending on what it is you're talking about exactly. 2 episodes there, deep dives on those, 20, 30 minutes long, can answer your question specifically. So check that out. And for anybody else out there looking on, wondering about rates, wondering about the market, looking for a deep dive, check out, again, the podcast. It will guide you in the right direction. So we have been on almost 2 hours here. We're going to start wrapping it up. I'd like to ask that favor again. If you hit the like button, show, that you appreciate us being here, that you found value. That does help us out. There's a link scrolling at the bottom now. If you need that realtor referral, if you need that mortgage referral anywhere in the United States, we can get you connected with a realtor, with a mortgage professional, both, if you will. So just go to that. Also, last week I mentioned there's a link in the description. It's there. I don't know if I have one on here that I can add. I think I do, that I did one. This newsletter. So going to start doing a newsletter deeper dive into some data, some trends, what we're reading. I haven't sent one out yet. I plan to do it. So if you have any interest in being a part of that, go to that newsletter. Give your information there, just an email and a name. It's not spam. It's really just providing you with some, essentially everybody's always asking, what are Josh and I reading? What are we finding value in? That will be part of that. So Josh, anything you want to add here as we exit today? Oh, lastly, before Josh goes, next week, not going to be here. Next week, we're taking off. We're going to take a week off. Okay.
I thought we were going to do the following week off.
Are we doing the following week?
Following week. So we'll be here next week. We will not
next week we'll be here.
Week.
Just disregard that. I lied. Sorry.
Premature vacationing.
Yes. Anyhow, go ahead. Sorry.
No, I was just going to say, we have a question here, and she very politely asked it twice at long distances in posting, so I wanted to get her answered. So Kara Vlogs just wants your opinions on buying versus building as a first-time buyer. And now, granted, this is a weak spot for both of us because there's not a lot of building. You can buy new construction, newly built homes here in our market here in California, but not a lot of people taking out construction loans and building their own home. What are your thoughts, Jeb?
Honestly, I don't think people understand what it is to build a property. Do you have the money to buy the land and build? These aren't, again, it's, if you can find a home that is already built that matches what you want, I would say it's in the market that we're in right now, it's probably, I wouldn't say less expensive, but something that you should consider versus going out and trying to build in the environment we're in, because finding good help, finding the cost of material, the cost of workers is just astronomically high. And I think people have an idea that they're going to go out and be able to build a house for significantly less than it costs to buy something already built. And in some markets, you might be able to do that. In other markets, I don't know that that's the case. So if you're looking for something specific, you've got your own taste that you're trying to really dial in, and that's the only way, then maybe. But talk to a lender and have that conversation too about the difference in loans and what type of loan you're looking for. Getting financing for land and being able to build is completely different than getting financing to purchase a house, an existing construction house, Josh. Outside of that, I don't have a ton. But buying something newly built, building your own newly built, whatever, there are additional costs once that house is built of things that you have to do to that house versus something existing as well. So it's not always, grass is greener on these scenarios.
Let me just answer it this way. Currently own 5 pieces of real estate. I've bought and sold over 50 homes in the last 15 years, including major renovations. A goal or dream of mine is to build my own home so I can build it exactly the way I want. In the current market, in the current environment, I would not
be a contractor on that deal. Just telling you, don't be there. If you get Josh calling, you do not return the call.
Just be real good at your job. Just be real good at your job. I know what I want and I like what I like. Just saying, in the current market with supply chain issues, with labor really tight, contractors in high demand, there's no world in which I would try to build a house right now. So as a first-time buyer, extrapolate with you from that what you would, but I wouldn't do it.
No, good stuff. Very last question, promise. Ed said, just subscribe to the podcast. Any favorites? Honestly, I think the first 3 or 4 episodes of the podcast outside of our introduction are really good. Why homeownership's important. Buying versus wait. Those are like things that I think as a first-time home buyer, you really need to take into consideration. But depending on where you are in the process, I think there's an episode for you. Even if you're not a first-time home buyer, there's a lot of really good information on there. So do us a favor, check that out. We will be back next Wednesday, as Josh mentioned. Until then, we appreciate you being here. Adios.